Chapter 4, Problem number 1. In this problem, we have two assets. The life of asset A is 3 years, and the life of asset B is 5 years. For asset A, its initial cost is 17,000. To figure out the first year depreciation, we multiply 17,000 by 33%, which is the depreciation rate based on table 4.2. So the annual depreciation in year 1 for asset A is 5610. In year 2, we multiply initial cost by 45% to figure out the annual depreciation in year 2, so on and so forth. For asset B, it has 5-year life, so based on table 4.2, the first year depreciation rate is 20%, and we multiply 45,000, the initial cost for asset B, by 20%, so the depreciation for asset B in year 1 is 9,000. In year 2, 45,000 times 32%, the depreciation is 14,400, so on and so forth. Chapter 4, Problem number 4. In this example, we need to find out the operating cash flow. We are given the amount of the assets of the firm, 190,000, and also we know this asset is in the 3rd year of depreciation, and this asset has a 5-year life. Below in the table, we are given a bunch of numbers. Please note, we will not need the accruals numbers and some other balance sheet numbers such as the current assets and even the interest expense from the income statement. Now let's do it. To figure out the operating cash flow, we begin with the top line from an income statement, which is the sales. The sales number is given from the previous table, 400,000. Then we subtract the total costs. This number again is from the previous table, 290,000. In the book, this number is also called the cost of goods sold. After subtracting the total costs, we need also subtract the depreciation. The depreciation of this asset in year 3 is equal to its initial cost, 180,000, times 19%, the depreciation rate find out in the Macker's table. So the annual depreciation for this asset is 34,200. Once we subtract depreciation and the costs from sales, we will get the earnings before interest and tax. That number is 75,800. Then we need to pay tax. The tax rate is given as 40%. So if you multiply 40% by 75,800, the tax liability for this firm is 30,320. So subtract tax from earnings before interest and tax. We will get net profit after tax. And this number is 45,480. To get the operating cash flow, we need add back the depreciation because depreciation is a non-cash item. So the operating cash flow is equal to 79,680. What is the effect of depreciation on the firm's cash flow? Because depreciation reduces taxable income, therefore it reduces the tax liability of the firm, and as a result, it increases the cash flow of the firm. Chapter 4, Problem number 6. In this example, we are given the balance sheet in both 2012 and 2011. In addition, we know the income statement. So we need to figure out the two cash flows and the net operating profit after taxes. First, the net operating profits after tax is equal to EBIT times 1 minus the tax rate. EBIT from the income statement is equal to 2,700. Tax rate is 40%. So the net operating profits after tax is 1620. Part B. Operating cash flow is equal to net operating profits after tax plus depreciation. And the net operating profits after tax from Part A is equal to 1620. Depreciation, according to the income statement, is 1600. So operating cash flow is equal to 3220. In Part C, to figure out the free cash flow, first let's do the net fixed asset investment. This number is equal to the change in net fixed assets plus the depreciation in 2012. 14,800 is the net fixed asset balance in 2012, and 15,000 is that number in 2011. So the difference is change in net fixed assets. Plus 14,700, this number is the accumulated depreciation in 2012, minus 13,100, which is the accumulated depreciation in 2011. So the net fixed asset investment is 1,400. Next, net current asset investment is equal to change in current assets minus change in account payable and accruals. 8,200 is the current asset in 2012, and 6,800 is the current asset in 2011. So the difference is the change in current assets. 1,600, this number is the account payable in 2012, and $200 is the accruals in 2012. So the sum of this 22 number minus the sum of the 2011 number. 1,500 is accounts payable in 2011, and 300 is the accruals number in 2011. So net current asset investment is 1,400. Lastly, let's figure out the free cash flow. Free cash flow is operating cash flow minus net fixed asset investment and minus net current asset investment. Recall, operating cash flow from Part B is equal to 3220. Next fixed asset investment from previous step above is 1,400, and net current asset investment is 1,400. So the firm's free cash flow is 420. So it has positive free cash flow. The reason is because the firm's operation generates 3220 operating cash flow, and out of it, the firm uses $1,400 of it to invest in long-term assets and another $1,400 in current asset investment. So after the investment, the firm still have $420 left. That's the so-called free cash flow. Free in the sense that this $420 is free to be distributed to stockholders of creditors.